All right, welcome everyone. I'm here to talk about commercial lending today. Before I get into commercial lending and how you can get financing today, I want to talk a little bit about the good old days and go back to my early career. Back in early 2007 or I should say mid 2007 is when I started, and qualifying for a mortgage back then is quite simple. If you had a pulse, you got a mortgage. Not quite as simple as that, but it was pretty darn easy. Things have changed quite a bit now. This is a better representation of what it looks like in our office. Paper flying around, the amount of documentation that we need nowadays is significantly higher than we used to, and it does take a lot more time to get a mortgage done too. The primary reason for that, of course, is that the government is ensuring that people income qualify, so qualify based on their income, not based on their down payment or simply their credit. Really general rule of thumb is if you're qualifying for residential financing, then you usually need about $20,000 in income for every $100,000 you're borrowing, assuming you have no other debts. And they also want people to qualify based on the stress test, which unfortunately reduced borrowing power by about 20%. So it's definitely made a dent in what people can qualify for and made things a lot more challenging. So now we're finding that our borrowers are not being able to get qualified on the residential side, and it's leaving the broker trying to find an alternative. So what a lot of our clients are starting to look at is going commercial if they aren't already a commercial client. So the amount of commercial financing that we've been doing over the last 4 years or so has been more than quadrupling every single year. So we've been finding that our commercial segment is growing at a significant pace. So what is commercial? Commercial would be, this is just a real highlight, but commercial would be 5+ units residential, so a multi-family building. Retail, strip mall, industrial development. There's quite a few things, and I'm actually going to go into a little bit more detail about all of the little tiny things that we can do on the commercial lending side because it's really expansive. So the first thing I want to go over, because most people are more familiar with residential financing than they are commercial, I want to go over a highlight of what this looks like. Oh, you know what? I forgot to hit record on the stupid thing again. So let me just. No. Yeah. I have to because I have to hit record on this thing too. Fuck! What a waste of time. Yeah. Hi, everyone. Welcome to the commercial lending webinar. Before I get started, I just want to talk a little bit about what it was like to be a mortgage broker back in the good old days. So when I first started in the business, things were quite easy. Back in before 2008, before the subprime crisis, it was quite easy to get a mortgage. It was about as simple as checking your pulse and making sure that that you could fog a mirror. Things have changed a little bit, and it's a lot more difficult now to get qualified, especially if you're getting residential financing. This is what it looks like in our office. Not quite, but pretty close. The amount of paperwork that we need compared to previous is significantly higher. It takes a lot longer to get a mortgage processed, and the primary reason for that has been government intervention. The government has really stepped in, and they're ensuring that people qualify for mortgages based on their income, not based off of their down payment or their assets. They also want people to qualify on the stress test as well, which means that they have to qualify at a rate of about 2% higher than the actual rate they're getting. So the biggest challenge is we used to see that people would need only about 16 grand in annual income per 100 grand they're borrowing. And now you need about 20 grand in income per 100 grand you're borrowing to qualify for a mortgage, assuming you have no other debts. So it's leaving a lot of our borrowers stuck not being able to get qualified, and it's leaving the broker trying to find an alternative solution. So a lot of our clients have been going commercial. About the last 4 or 5 years, our commercial book has grown about 400% year after year. And the main reason for this is just finding that more and more challenges are coming up on the residential financing side. More of our clients are looking for all options and alternatives on the commercial lending side. So what is commercial? There's a number of different things that classifies commercial. Here are the 4 primary ones that we see. 5+ units residential, so there'll be a multifamily building. retail strip mall or retail space, industrial parks, development deals. All of these would fall under the commercial banner, and there's a lot more too that we'll go over in a little bit later in the presentation. So first of all, I want to go over the difference between residential financing and commercial financing, as most people here are familiar with residential financing, but not as familiar with commercial lending. So here's a quick hit list that we'll go through. So on commercial lending, the qualifications is based more on the property itself, whereas residential, it's based more on the borrower. Interest rates on commercial can actually be a little bit lower than residential. It's not common, and I'll get into how you can actually get a lower rate on the commercial side with CMHC insured multifamily financing. But in general, the rates are usually higher than residential financing. The loan to value, so the percentage of financing you can get, on the commercial side, you'll go usually between 50 and 75%. That's kind of your standard. I'll go into a little bit more detail again, how CMHC can give you more financing than that. On residential, you can get up to 80% financing for rental properties. Lender fees, usually about 0.25% to 1% for commercial. Usually there's no lender fee for residential. On the commercial side, the broker fee is usually 1% to 2% of the loan amount, depending on the size of the deal and a number of factors. On the residential side, it's very uncommon to charge a fee, although in certain cases, brokers may need to charge a fee depending on the type of deal that we're working with. Costs are very different too. On the commercial side, you can expect your cost to be minimum $5,000, but probably closer to 10 to 15 by the time that you factor in appraisal costs, which are often anywhere from $2,500 to, I've had appraisals all the way up to $10,000 before. Environmental studies, which can be anywhere from $2,000 to $6,000. The legal fees are at least $2,500 in general. So the fees definitely do add up on the commercial side, whereas residential is usually quite cheap. It's usually just your legal fees plus appraisal in most cases. Another big difference too is in commercial lending, getting a mortgage in a company name is very simple and easy. Whereas in residential, it's usually not. It's a lot harder to get financing in a company name. So we do find that that's one of the reasons that people are looking to commercial lending to get qualified. So I'm going to talk about qualifying for a commercial loan. And we use this term DCR quite a bit. It stands for debt coverage ratio. So a debt coverage ratio means that the lender wants to see that the income is 1.25 times all of the expenses. So if you had a property that generated $125,000 in gross annual income, and all of your operating expenses were $50,000, including your property tax, your utilities, vacancy, etc., the lender would lend to you an amount where the mortgage payments don't exceed $50,000 per year, because the two combined would be $100,000 in expenses on $125,000 in income. That's a 1.25 to 1 ratio for income to debt. So an example is a lot of the time when clients are looking at how much do I qualify for, we usually get some kind of analysis like this, where it shows the rental income, any in this case there's utilities income, because the landlord is actually charging the tenants for the utilities, and then you'll see that the little bit below there's water and gas and power, etc. So we will get an analysis like this, and we usually also look at the rent roll to determine the total income, and make sure that the rent roll isn't much higher or much lower than the financials. And sometimes if the rent roll is much higher, we want to, as a broker, we try to push the lender to use that if the trend has been improving. And sometimes the rent roll is much worse, which makes our case a lot weaker to use the financials. So we're always trying to figure out which one we can use, the financials or the rent roll, as far as what the income is. And then once we have all that information, we do up an analysis on our worksheet to figure out what's the maximum loan amount that we could get this individual. So using those numbers that you saw earlier, we're looking for this debt service coverage, this number here, 1.33, which would mean that we can get 75% financing on this particular building. So we always want to run the numbers and figure out what our maximum loan amount is based off of the income produced by the asset. There's also CMHC financing. So CMHC financing is a little bit different in the sense that the debt coverage ratio can be as low as 1.1 and sometimes as high as 1.3. So depending on the situation, the debt coverage ratio can be more flexible or less flexible. this is a major key here too. The loan to value can be up to 85%, but often is not. So CMHC, what they do is they actually do their own valuation on the property, and they use their own numbers and ratios. So a lot of the time they'll say, well, I see your financial statements, but we want to use a vacancy of 10% for that market. We want to increase the expenses by 3%, which is pretty common. They'll factor in all these additional items, and by the time that they've done their analysis, maybe they will give you 85% financing, but it'll be on a much lower purchase price according to them, or a much lower lending value, which doesn't give you as much financing. So a lot of the time, CMHC ends up being only about 65% financing. Your cost to go through CMHC is an application fee of $100 per unit or bed. And then the CMHC insurance premium that gets added to the mortgage amount is between 1.75% to 4.5% of the loan amount, plus a quarter point for every 5 years in amortization over 25 years. So if you're trying to get a 40-year amortization, then you need to add another 0.75% onto that amount. Amortization, so you can get up to 40 years. It's not extremely common, but it is possible, particularly if it's a brand new building. It's a lot easier to get the amortization up to 40 years. Interest rates are usually below residential. Currently, that would be around or just under 3% interest rate as of right now, which would be May of 2019. And requirements, the insurer does want to see that at least 25% of the loan amount in net worth, so minimum 100 grand. So if you're looking for $1 million loan, they want to see that your net worth is at least 250 grand. Ideally, liquid assets. They want to make sure that if something happens to the property and you need some cash really quickly, that you have the financial capabilities to be able to do any work necessary to the property to fix it up. Personal and corporate guarantees are required, and you must engage a property manager and have some kind of signed contract unless you are a property manager yourself. So they really want to make sure that these units and buildings are properly managed. And CMHC financing is only available for multifamily buildings, not for retail or industrial or anything like that. They need to see that that most of the building is residential. They're okay with a small percentage of it to be commercial. So if you have a building where the main floor is all retail strip mall, for instance, and the rest of it's residential, then usually that's okay. But no more than about 20 to 25% of the building can be commercial. So types of financing, we do quite a bit. So there's affordable housing, which is pretty neat because CMHC does have some incentives that will make affordable housing a lot better especially for a builder. So if you're building a multifamily building, you plan on renting out, and it might fall into the affordable housing category, you can get up to 95% loan to cost financing for your construction. So it's very lucrative if you fit into the criteria. There's multifamily financing, which we just spoke about. Single room occupancy. So a single room occupancy is something where you're sharing, usually you're sharing some of the amenities. So bathrooms, kitchens, etc. You'll find a lot of these in major urban centers like downtown Vancouver. Single room occupancies are quite common. A lot of these are buildings that have a different type of tenant profile, let's put it that way. So it is a little bit difficult and more challenging to get financing up, but CMHC will consider insuring those. Business financing, so we do a lot of business financing too. It does not have to be real estate backed. So that's something to keep in mind. I have a couple of examples of some of the loans that we've done recently that were strictly business and wasn't tied to any real estate. Retirement homes, anything where you're providing respite care or elderly care, etc. Those can fall into something that we can finance, and in fact, CMHC will also consider those types of buildings as well. Looks like I had affordable housing here twice, and construction is another thing that we do a lot of, and quick business loans too. So if you're needing a quick business loan for anywhere from 25 to 100 grand, we have access to that. We use BDC for a lot of our loans. That's Business Development Canada. There's a number of other sources with certain banks who, again, some of them are more competitive than others. So we find that we're shopping that around depending on where the right fit is. But right now, we have a couple of banks that have really attractive loans available for short-term financing. Something that I really wanted to hit on today is the multiplier effect, which is a really cool really cool. I'm not going to call it a hack, but it's a really cool thing to understand and a very important concept. So first of all, let me explain how these three items here on the screen are interchangeable and work with each other. You have the net operating income, you have the cap rate, and value. So net operating income is the income after all the expenses are paid for, not including mortgage and not including any large-scale renovations that were done to the property. So ongoing maintenance would still be included in that calculation, but if you redid a roof, that's not something you'd be doing every single year. So that would not be included in the NOI calculation. You have the cap rate as a percentage. So a cap rate is a very important term to understand. A cap rate is essentially what rate of return you would expect if you bought the building with cash. So if you bought a building with cash for $1 million and it put $50,000 back into your pocket each year, that would be a cap rate of 5% because you're getting a 5% return on your cash each year. And then you have the value. Now, if you have two of these numbers, you can determine the third. So I want to paint a little picture here for you because it's a really cool strategy for a lot of our investors, especially on the commercial side, because everybody's buying these buildings for the income that they generate. So let's say that you're buying in a market where the cap rate is about 5%, and each market has their own cap rate. A small town's more likely to have a very high cap rate because it represents more risk, and therefore you would expect as an investor to get a higher return on your cash. Let's say that the net operating income is increased by only $1. In this case, the value is actually increased by $20. So if we look at this and zoom out here, if you are buying in a 5% cap rate market, that means that somebody's willing to pay $20 to get $1 per year in net operating income. Okay? So again, if you're buying in a 5% cap rate market, for every $20 in value, so if you're buying something for $20, you'd expect $1 back in net operating income because you're getting a 5% return on your $20 per year. What this means is that if you increase the NOI for every $1, if you actually increase the building value by a multiplier of 20 times that in this cap rate market. If the cap rate was 10%, let's say, then every $1 increase in the net operating income would increase the value by only $10. So in a way, a low cap rate can actually offer a higher opportunity to improve the value in properties and improve the equity that's in your properties significantly. So let's go in and actually show you an example here of how this would work. I know a company who's done this quite extensively, and this is one of the examples that they had, which I thought was pretty cool. So they had a 200 unit apartment building. In that market, it was a 6% cap rate. What they did is while they had it under contract, they slipped notices underneath the doors to ask each individual tenant if they would pay $50 more per month for washers and dryers. So that would be per unit that opts in, that would be $600 extra per year. 100, so 50% of the people said, you know what, I would pay an extra $50 a month for a washer and dryer to be installed in my unit. And so that represents an extra $60,000 in income per year. The cost of putting the washers and dryers in there was only about $1,500 to $2,000 per unit because one of the closets actually already had the hookups for washers and dryers. They just never installed them. So the cost is only $150 to $200 grand. But in this case, at a 6% cap rate, the value of the building goes up by $60,000, the net operating income, divided by the cap rate, which in that market was 6%, which means the building went up by $1 million in value. So they put 150 grand to 200 grand into it and generated $1 million in value. Now, probably the even cooler part about this was down in the US where it's very easy to get financing. They have a program there where year after year you can show your new numbers and you can get up to 75% financing on the building that way. And so they were actually able to pull out $750,000 back out of the building. They only put 150 to 200 grand into it, and they pulled out 750 out of it. So they actually generated a ton of cash right out of thin air and put that right back in their pocket, which definitely increased their return on their investment. Let's go through some examples of some of the commercial deals that we've funded in the last year and a half. We financed a sixplex on Vancouver Island. The interest rate was 4.35%. We ended up getting 75% financing on that one. I financed a big development project also on Vancouver Island. It was a $21 million land financing draw. The interest rate was quite high. It was prime plus 10.6%. Yes, you're reading that right. Prime plus 10.6. 55% financing. So that 21 million was representing just a little bit more than half of the appraised value of the project. That project's going to be a 7 to 8 phased, approximately 700 units are slated to be built on that land. We financed a retail space up in Kelowna. This was a brand new location, and the client's financials weren't extremely strong. We were able to get 60% financing, and this one was done with a Canadian Small Business Financing Act program, which is a government-insured program, which means the rate was a bit higher, but it allowed the bank to be more comfortable with doing this loan. So again, 60% financing at 6.35%. We did a development deal up in Kelowna. That one was 70% financing, prime plus 1.25%. It was 1 year interest only, and it was fully open. This is up in Kelowna where there's some new zoning changes to what's called RU6, which allows for this client is actually subdividing a lot into 5 different lots. One of them is going to keep the house on, and then the other 4 he's selling individually. CMHC multifamily, we did a deal up to 75% with CMHC. The rate was 2.85% for a 5-year fixed term. And in the construction, we financed a couple deals at prime plus 2% at 75% loan to cost. So you notice that that typically we say loan to value. In construction, the term is often loan to cost because the banks don't want to lend on the potential value of a project once it's complete. They want to lend on your actual physical costs. A couple more examples. I just got a quote back the other day. A dentist is looking at buying the building that she already works out of. The bank was able to and willing to do up to 100% financing at prime, which is really, really good terms. We just did a business loan late last year. It was a $15 million loan, 1 year interest only at prime plus 10%. And this client, it's a large fund, and they were actually purchasing an existing business that had a forestry license. And so they're essentially acquiring the forestry license and all the equipment and whatnot along with that. A pretty interesting deal. Don't really have time to go into it now, but pretty interesting one. And last week, I got an approval on a different business loan for $2.2 million. The purchase price on this one was $3.5. It's a 5-year term with a 10-year amortization, which is very common for these unsecured loans. The interest rate was 4.85%, which is very competitive. And this was for a company that's they specialize in online resales. So primarily a virtual business. Very cool, very interesting guys that are buying that business. So let's talk a little bit about residential versus commercial and the pros and cons to doing each. So first of all, let's look at the pros. Generally, if you're doing a commercial loan, you're getting economies of scale. So you're generally buying, if you're buying 100 units, you're usually buying them for less than an individual unit would go for in the market. You're also qualifying based on the property itself, not based on your own personal income, which for a lot of our borrowers is a really important key. And there's make sense lending, which frankly, if you've been trying to grow a real estate portfolio on the residential side, you've probably run into some pretty stupid things that banks have said before that don't really make a lot of sense. On the commercial side, there's way more fluidity here. Does the deal make sense? Yes or no? Okay, let's do it. So you're going to find that things are a lot more flexible on the commercial lending side. Let's talk about the cons, though. It's not all roses. In general, even if you're a strong borrower, usually the down payment is a bit higher. Unless you're looking at owner-occupied units, like that dentist example is a good one. If you're going to occupy the unit yourself and your financials are very strong, you can get away with a much lower financing percentage down. But in general, it's usually a higher percentage down payment. There are higher fees, and in general, the rates are higher than residential rates as well. I'm going to go into an FAQ before I wrap things up. First of all, I don't have an income. Can I qualify? So yes, the underwriting is based primarily on the property when you're getting into commercial lending. So they look less at your personal take-home income and then look more at the income generated by the asset. Now, if you're looking at buying the space that you're going to occupy, then they're going to look at your personal financials to make sure that you can qualify. So they look at your personal take-home income, but also your business financials too, like the dentist example. They're going to be looking at the financials of that company. But if you're buying a standalone rental building, they're going to be looking at the income produced by the asset to determine whether they're going to lend to you or not and how much. The good thing about commercial lending is that in general, you usually do get qualified for some amount because the property will always service a certain amount. However, you do find that sometimes if you're a really, really strong borrower where you could easily get 80% financing on a residential property, on commercial it doesn't matter. We had a situation a few years ago where a client was only able to get 50% financing through their bank, and they had $6 million in assets with that bank, in stocks and bonds, et cetera. They also had an income of well over about $500,000 per year net and no mortgage on the residence. They were slam dunk clients, but they came to us and we found another lender that was able to give them 55% financing. So not a lot more. So the underwriting really is determined by the income produced by the asset, not by the individuals. Can I buy in a company name? Yes. In fact, this is usually preferred on the commercial side. So you won't have as many difficulties or challenges with doing this. And can I buy residential properties using commercial lending? And the answer is yes. So we call this a commercial blanket loan or inter alia loan. These are doable. They are challenging. We do find that we're usually doing these for clients that have built a real estate portfolio on the residential side, and they start hitting that wall where it's very, very challenging for them to get qualified. They have too many mortgages on their personal credit bureau, and now they can't even qualify to purchase a new residence for themselves. Sometimes we'll look at a commercial blanket, which would take all of these, wrap them in underneath one company, get them under the commercial lending umbrella, which generally would not report in your credit bureau, and switch everything over. And in general, because it's a lot of work and there's a lot of properties involved, usually it's at least $2 million in funding required. I've done a few that were a little bit less than this, but usually you need at least $2 million in total mortgages in order to pull that off. So how do you get pre-approved? You don't really get pre-approved on commercial lending because every property is different. So it's a property to property basis. It's not like residential financing where your income determines how much you qualify for. And commercial, every deal is different. And so really when you're trying to get pre-approved, you have to send us each property and we do the analysis and figure out, hey, this is how much you can qualify for on this property itself. How much down payment do I need? It varies, but between 25 to 50% usually. The majority of our deals sit around 35% down payment. And what are the timelines? So timelines, typically you're looking at about 4 to 6 weeks for financing and about 4 weeks for closing on top of that. So if you're writing an offer and you're trying to figure out how long you need for your subject clauses in your offer, usually you should be writing at least 4 to 6 weeks for the financing clauses. And then after that clause ends, another 4 weeks for closing. I would recommend that you do write in your subjects that the clock starts ticking for your financing clause once you've received all of the documentation that you've required from the seller. That way the seller doesn't take 3 weeks to get you a bunch of documents that you need, and now you only have 1 to 3 weeks left to finish up your financing, which could be very short. You don't want to be paying for things like appraisals and environmental studies unless you know that the financing seems like it will likely work and you've done that analysis. It's a bit of a chicken before the egg thing sometimes, guys. When you're writing an offer on a commercial deal, you don't really know what the numbers are going to look like until you've written an offer because they don't want to release their financials and the rent roll, et cetera, to you unless you're actually you're into the deal and you've actually written an offer. A lot of the time, and I will warn you that realtors, when they're listing a property, often those numbers are pretty rosy. It's very, very uncommon for us to see that the pro forma given by the sellers to a prospective buyer are actually accurate. They're usually not very accurate, and they're usually, of course, a little bit more optimistic from the seller's perspective. And so you always have to keep that in mind, and that we'll do the analysis based off of the numbers given to us in the pro forma, but often once you get the documents back, they're not quite as strong. So at this point, I'll open up the floor to any questions, and if anybody wants to learn more about commercial lending, obviously they can reach out to us. We'll make sure that we'll send a copy of the webinar out to everybody who's attended today, so that you can read this and study this. And if you have any questions, we can take it from here. So I'll open up the floor and see if anybody wants to ask anything here. It doesn't look like anybody has any questions. So what I'll do is I'll leave it for now, and in